thank you for being here for this important meeting. It's always good to see some of our retiree beneficiaries here with us. Thank you all for coming also. As we begin, let me ask who is joining us on the phone. Reynolds, are you there? Okay, and Bill Condon, are you there? Anyone else on the phone? I think Alan is with us soon.
Yeah, there's nobody else.
Not yet.
Not yet. And Alan, I think he's right after that too.
Okay, so he'll be right in.
But you do have a quorum.
Thank you. We do have a quorum, even with people missing for a while. So the first order of business is the proposed agenda. Do you have any comments or questions about the agenda? May I have a motion to adopt the agenda?
Mr. Chair, I move that we adopt the agenda for today.
And a second?
Second.
All in favor say aye.
Aye.
All opposed? Okay, so we adopt the agenda as presented. The next order of business is approval of the minutes of previous meetings. First, you'll recall that the February minutes were carried over for so that the discussion could be expanded. So any comments or questions on the February minutes as expanded? And secondly, any comments or questions about the April meeting minutes? If not, may I have a motion to approve the February and the April meeting minutes?
Second.
It's been moved and seconded. All in favor, say aye.
Aye.
All opposed? Thank you. All opposed, say no. Okay, Reynolds, is that you on the phone?
It is I.
Well, thank you for being with us remotely. Thanks very much.
You're welcome. I had a doctor's appointment at 8:30, or I'd be in Columbia now.
Okay, the next item is the chair's report. My report will be covered in the executive session. The next item of business is the report of the Audit and Enterprise Risk Management Committee. Bill Hancock.
Thank you, Mr. Chair. I'm happy to report that on Tuesday, June the 4th, the Audit and Enterprise Risk Management Committee met. And some of the things that went on there are as follows. We received an update on compliance. There's some routine compliance matters information we received, and there were no material exceptions noted. In addition, an update on the continuing build-out of the RSIC's enterprise risk management function was received. All right. Here's an update on our internal audit discussions and issues. We were provided with an internal audit update about the cash management implementation review, which will likely take place in the latter part of calendar year 2019. The committee was also made aware that an agreed-upon procedures review of RSIC's cash disbursements and payroll functions will be conducted for the period ending June 30th, 2018. The executive session, we met to discuss the recently issued request for information for internal audit and consulting services. We're trying to select a vendor. We had the state auditor's pre-approved vendors list, and we have come to a recommendation by staff in agreement with our committee, and we will disclose who that vendor is after staff negotiates the contractual negotiations to that. As a reminder, the committee is planning for the vendor to conduct a risk assessment and present a 3-year audit plan for approval by the committee at its August meeting. The vendor will then execute the 3-year audit plan. And finally, the committee received presentations on South Carolina Retirement System's valuation policy and procedures, as well as RSIC's and Alborn's operational due diligence procedures. That's my report, Mr. Chair. Any questions?
Are there questions for Mr. Hancock? Thank you very much. The next item is the report of our Chief Executive Officer.
Thank you, Mr. Chairman.
Right.
First off, I'd like to start out with some recognitions. If we all kind of look to the right over here on the right side and right in front of the curtain, we see a host of which are much younger faces than mine. So, and these are folks that I would like to spend some time recognizing. Just about pretty much all of the time that we have a always on internship program. Now, of course, that picks up a little bit more in the summer. And what we have over here is a representation of our summer class of 2019. And really the internship and our analyst trainee program has expanded greatly over the past couple of years. And that is primarily the responsibility and the vision and the hard work of Brian Moore, Steve Marino, and Kevin Matherly, who both created and have implemented that program. We've seen the great thing about having being co-located near USC as well as some other universities is that we have the ability to draw on just a vast array of talent for our internship program, and then that feeds our analyst trainee program. And our analyst trainee program has really developed a lot even better than I expected, and has truly served as a farm team for us. We have, out of that program so far, we've had 4 people graduate from that program. 2 of those folks went on to careers outside of the organization, went to great firms. And we've also graduated 2 of those folks out of the program into permanent full-time positions here in the organization. So that we have been able to build a strong bench, and that continues. I would say that both at the people that are entering the junior analyst program that I'll introduce in just a minute, our law clerks and our interns, I think we've got the strongest class that I've seen since I've been here. But I just wanted to take a minute to introduce some of these folks. First of all, I'd like to introduce Noah Neeson. He's a new junior analyst, just joined the junior analyst program. He graduated from the College of Charleston with a BS in finance and a minor in real estate. So he joins us he's going to be is a brand new junior analyst, started this week, right?
Yes, sir.
Yeah, very good. Also like to introduce Aaron Taylor. Aaron has taken much like myself, has taken a little bit of a different path to be with us as a junior analyst. He graduated from law school. Try not to hold that against him. Recent graduate of the Charleston School of Law, and much like our chief investment officer, minored in English at the University of South Carolina. So great things. Based on just those 2 things, his future is definitely bright. So. We also have Rebecca Howard, who is not with us today because she is at home studying for the CFA exam. But she was an intern to analyst trainee and is a new member of our analyst trainee program. She just graduated from the University of South Carolina with a Bachelor of Science in Finance. So we're very, very pleased to have her. We also have 2 new law clerks, Miyoshia Bethay is a rising 3rd-year law student, and she majored in business administration when she was an undergrad at USC. We also have Cooper Melvin. He's actually from Alabama. We don't hold that against him whenever Alabama comes. He beats up on the University of South Carolina. But he's also a rising 3rd year, and he majored in accounting at the University of Alabama. And then as far as our interns go, Erica Swartley is a compliance and operations intern. She's out sick today and couldn't be with us, but she's a junior at USC. She is getting a BA in Management and Finance with a data analytic concentration. We also have Michael Mole, who is also a compliance and operation intern. Michael is from Boston, North Carolina. He's a sophomore at USC. He's also majoring in finance and Master of Accountancy and Taxation, and is actually a really good bowler, we found out, so, at our recent bowling event. So we have Kenzie McMillan. Kenzie is an investment team intern. He's from Somerville. He's currently in the International Master of Business Administration program at the University of South Carolina with a specialization in investment finance. We also have Jack Starbarkis. I said that right. He's from Jefferson, South Carolina. He's a rising senior and integrated information technology major. Then we have Kennedy Lewis, who's also an IT intern. He's a senior at USC and is also an IT major. And then we have Zach Brown. Zach is a risk intern, so he's working with James Wingo and his team. And he is has a BA and MA in criminology and criminal justice from USC. And he is currently a fourth-year doctoral candidate in criminology at USC. So very pleased to have him as well. So just wanted to take a moment and recognize all these folks. They're all hardworking, very intelligent, bring so much to the organization, and we're pleased and honored to have them, and look forward to helping them develop their careers, and I think each and every one of them has certainly a bright future ahead of them. So, otherwise, Mr. Chairman, in regards to my report, just wanted to give a quick update in regards to the agency budget. The General Assembly has completed they completed the budget. They're coming back for budget vetoes, I believe, on June 25th. Thankfully, none of those involve us. Our budget was approved. Just a reminder that we did ask for a $500,000 reduction in our authorization, which thankfully met with little resistance, some degree of surprise, but little resistance. But it is a reflection, I think, of the ability to do that is a reflection of all the hard work that the folks at the agency have done in order to find out ways to operate the organization in the most efficient manner. Always mindful of the fact that any dollar that we spend in regards to our operations is one less dollar that we can invest in the trust. So always trying to make sure that we're using those dollars to the benefit of our beneficiaries. So, and that is my report, Mr. Chairman.
Thank you. Are there questions, Mike, about his report? All right, then, moving on, the next item on the agenda is the report of our Chief Officer of Finance, Chief Investment Officer, Jeff Berg.
I might prefer that type. So thank you, Mr. Chairman. I am going to do plenty of speaking later on. So as an act of mercy, I'm going to step out of the way and let David King give us our performance update.
Good morning.
Good morning.
All right.
Today I'll be going through performance through April 30th. And this will be a slightly abbreviated update. We got our numbers last week, and we're also between quarters. But looking at the plan performance, you can see fiscal year to date, the plan is up 5% versus a policy benchmark of 4.83. You can see over this period we've paid $929 million in net benefit payments. Looking at our performance in dollar terms, you can see we started the period at $31.3 billion. We paid out $929 million in net benefit payments, and we've gained an additional $1.5 billion through investment performance. Expanding out the $929 million of net benefit payments, you can see we had $3.4 billion of outflows to beneficiaries, $2.7 billion of deposits back into the trust, and we had an additional $376 million outflow due to the Terry program, which was unwinding this year. and also a $105 million legislative inflow. Looking at our portfolio exposures versus our policy targets, you can see we continue to hold an overweight to public equity and also to cash. That's being offset by an underweight to mixed credit and core fixed income. Looking at our plan NAV through time, you can see in April we're $31.9 billion. We're just under our previous peak in January 2018. Since the RSIC was created, we've paid out $13.3 billion in net benefit payments and have increased the assets over $6 billion. Looking at our fiscal year-to-date relative performance to our peers, to the Bank of New York Trust Fund, greater than $5 billion universe, we're in the 43rd percentile. Our rolling 1 and 3 years are in the 72nd percentile and 77th percentile, respectively. And moving on to our performance, we've had a strong calendar year. Since the drawdown in December, public equities were up 16% just broadly since January. And looking at our fiscal year-to-date returns, you can see just about every asset class is positive, with strong returns in public REITs and public infrastructure. Looking at the relative returns versus the policy benchmarks, you can see other opportunistic continues to be our highest outperforming asset class, followed by private equity and equity options. On the other end of the spectrum, you can see private infrastructure, portable alpha hedge funds, and mixed credit underperforming. And at this point, I'll pause and ask if there's any questions.
Could you go back to one of the first slides that showed our return, the 3 and 5 year period
Yes.
relative to our assumed rate of return? I just wanted to point out that our one of our goals in our strategic plan is to exceed the assumed rate of return over the trailing 3 years. And so, as you can see, at the end of April, we did achieve that goal. Of course, it changes every day with the market, so keep that in mind. But this is not an instant measure, it's a 3-year average, so I'm very pleased to see that return.
Well, I think, Mr. Chairman, and I think even kind of the better news, I guess, is over the 10-year period, we've substantially exceeded the assumed rate of return, but, of course, always mindful of the fact that the reason for that is the fall off of the quarters associated with the financial crisis too. But seeing the, exceeding it over, but that global financial crisis number is also built into the since inception number, but certainly at least over the past 10 years, we've been able to exceed that.
Mike, is there any thought to the discussion about reducing the assumed rate of return? Last time we did it was what, last year?
It was 2 years.
2 years ago?
Yeah.
We did it in 2017, and so
2017,
we'll
yeah.
have an experience study in
Yeah.
2021.
And one of the things that in the legislation that was kind of the analysis that was the pension reform legislation, the analysis that was built into the funding was that we would, that in between the time that the bill passed and in 2021, when we basically we take another look at the assumed rate of return, that we would have a 4% annual rate of return over that time period, which, we've exceeded at this point. And then that the assumed rate would drop to 7, or that after that, or that we would get 7 for every year after that. So there is some cushion built into even to the assumed rate being 7.25. That was the scenario that the committee looked at when they were doing that.
Other questions for David King? Thank you for your report.
Thank you.
Thank you, David. Mr. Chairman, to move on to the next item, Commissioners, you may recall over the past 2.5 years, we have spent a great deal of time discussing our approach to co-investment and working on that. It's hard for me to think personally of another initiative that could have the impact on the plan's returns and frankly, the cost of the portfolio outside of setting the asset allocation. The work of the past 2 years has related to how we can best design an approach to structuring a private equity co-investment program as well as finding the right partner. We're thrilled today to formally announce our partnership with GCM Grosvenor, a firm that expands our capabilities materially. Our partnership will no doubt help us establish ourselves as a preferred LP with a reliable, organized, efficient process and a streamlined decision process. I've asked James, who's done a tremendous amount of work on this, along with other members of our team, to give us a high-level summary of the program and how it functions. So let me turn it over to him for this update.
Yeah, thanks, Jeff. So we're excited today, as Jeff said, to announce the partnership with GCM Grosvenor. Over the past 2 years, as we set up about designing our approach to co-investment, we've been fortunate to have access to a proprietary database that's just under 3,000 transactions, where we've developed a set of principles for how we think it makes sense to approach the co-investment space. So I'll go over those principles briefly here. Number one, all else equal, we think that a diversified portfolio of co-investments should outperform a similarly positioned portfolio of funds. And this is based primarily on the fee differential between those two. So that has important implications for how we would approach a co-invest program. Namely, we think it's important to build both scale and diversification into that program, and that's how we've designed it. Secondarily, we believe, based on a lot of our research, that GPs or the selection of our GP partners are more important than the selection of individual transactions. So as a result, we want to focus our underwriting efforts primarily on understanding our GP relationships. And once we develop those high conviction relationships, that allows us to streamline the underlying co-investment process. So thirdly, our access, we believe, to attractive opportunities is contingent upon our relationships and our rapport with our key GPs. And so what that means is we want to be the preferred capital provider to our GPs, and in order to do that, we need to make our investment decisions quickly and have excellent outward-facing communication with our GPs. So we've designed this partnership in order to be mindful of these things. We've elected to partner with GCM Grosvenor for our co-invest platform, and we've structured that partnership to represent, we think, the best aspects of both organizations' capabilities with respect to co-investment. On the one hand, what we want to do is take advantage of the considerable middle market relationships that GCM Grosvenor has, and we also want to take advantage of GCM's resources where necessary to capitalize on the transaction flow that we see and the opportunities that we see at RSIC with as much efficiency as possible. So when we think about the design of this partnership, what we really want to do most importantly is improve our competitive positioning amongst LPs in order to build a diversified platform of co-investments. And we want to be that preferred capital provider. To that end, the program is structured to allow us to best meet GPs' most important needs when they allocate co-investment. So number one, most importantly, we want to be responsive to GPs' need to have investors reach a decision quickly. We've designed the program and the process such that we're able to provide initial interest within 1 week and closing within 1 month from receipt of materials from GPs, and even faster than that for key GP relationships. Second, GPs want to build strategic relationships, and what that means for a GP is that those are relationships with investors who can commit in size to their funds. So we think we're an attractive partner, and we're positioned well with respect to that, because we do have an interest in building extensive primary relationships with new GPs, and we're currently underweight our private equity targets as well. GPs also want a reliable partner. They need clarity and can't be left wondering at the last minute whether they have their capital structure in place. And we understand that, and the program is focused on maintaining excellent communication and transparency with general partners. So GPs also want to offer co-investment to LPs where they can strengthen their relationships with LPs who are engaged. And as such, our partnership is focused on proactive engagement with our GPs. Flexibility in sizing is another key aspect that GPs need. And while our target sizing is between 10 and 30 million for our hold size, the partnership is designed to be able to also capitalize on opportunities that are outside of that band. So overall, we're excited about the partnership. We think the partnership brings together two complementary platforms, and importantly involves the three most important aspects required to create a successful co-invest program. One, we believe that Grosvenor represents a proven, well-resourced, and nimble platform with a history of successful co-investing. Two, they bring extensive relationships, particularly in the middle market, where RSIC is looking to expand. And also capital. GCM and Grosvenor have significant capacity to make primary commitments, and as well as RSIC. So to summarize, we're excited about opening this new chapter in RSIC's history, and are thrilled with the partnership that we've established here, and are committed to becoming a preferred partner to our key GPs. So, and we also welcome any inbound input as to how to engage with RSIC on the co-invest platform.
Thank you, James. So in summary, in layman's terms, this is going to be a way for us to improve returns without improving risk through the reduction of cost of our program. So,
Without increasing risk.
One question.
without adding, sorry. What did I say?
Can I ask one question? What's your ultimate target for the ratio of fund investments versus what you want to get in?
So what we're thinking right now is that if we execute on this, we'll be able to have for every dollar of private equity, think of 33 cents of that being co-investment. Potentially upside to that, but we want to be more diligent and methodical about how we get there.
Jeff,
Yes, sir.
could you give us maybe a down and dirty quick example of what, let's say $100 million private equity deal, what the cost is that we've had to bear in the past versus what projected cost would be on this co-investment platform, just to get that difference out there?
Sure. So typical, and Frank, feel free to jump in, typical private equity fund would cost, call it 1.5% plus 20% of the profits if certain goals are achieved. This is something would take, for co-investment that comes through our front door, 0. That's the best it will be. For co-investment that comes in through the other door, there would be an amount of fee nowhere near what the fund would cost. James, do you have an estimate on kind of the blended approach?
Yeah, the gross to net spread on the other side would be in the range of 150 basis points based on our estimates. So this compared to general private equity fund investing, where your spread given target return should be in the range of 600 to 800 basis points.
So to be as simple as I can, we're literally looking at saving millions of dollars of cost
Without question.
on basically each deal on the co-investment platform. Is that a fair statement?
Well, we're going to approach this from the perspective of, we don't want to do any single company transaction that is outsized. We want to do a number of small company transactions. But if you're thinking about, maybe we do 4 investments that equal that 100 million that we would otherwise be investing in a fund, we would be saving, yes, considerable amount on an annual basis, in the millions, without question.
On an annual basis, not just.
Yes.
Okay.
This is a
Gotcha.
recurring stream of savings.
Want to get
Just
that out there.
one question, operational question. Are these all gonna be closed in a single partnership, or is it gonna wind up being a whole bunch of different line items? What do the operational mechanics
What
look
the
like?
platform gives us is a place to close these. We don't have to use that if we have an existing structure in place, or if there's, for some reason, it is more advantageous. Sometimes co-investment is only offered in a sidecar that is established by the sponsor. But this would give us the flexibility for a deal that we needed to act on, and we needed a place to close it. We can always partner with Grosvenor and get it done professionally on that platform.
So is that gonna be like an open-ended fund structure of one then? I mean, like what's that actually?
I'll defer to
Are
James
we
on that.
pro rata in a pool that they have with other clients?
No,
on that, or-
this is not a pooled structure. This is a customized
Customized.
relationship
It's basically a fund.
Fund to one.
of one.
Yes,
Yeah.
yes.
Is Grosvenor part of a publicly traded financial institution?
No, they are owned, they are private equity owned right now. But, and I don't want to speculate on the future of that. And for those who may recall, we have invested, you can see that they, part of their business, the largest part of their business is hedge funds. Our legacy exposure to Grosvenor was in that hedge fund side of their business, and they certainly did well for us.
You might
But this
mention
calls
that
on a
they
different
bought
skill set.
CSFBs that runs a lot of special programs for states. What, they have, what,
Yeah.
39?
Yeah, that was
State
called
programs that they
CFIG,
run.
that business, and they had acquired that. I don't remember exactly when, it was years ago.
Yeah, 4 or 5.
Yeah. So,
But ultimately, the bottom line, Mr. Chairman, is we're open for business. So-
yeah.
So,
And this is gonna
Yeah.
help us not only on the, at the aggregate level, but we're gonna come to meet a lot of new firms that perhaps we might not otherwise have gotten to know.
Right.
So this is gonna be certainly something that helps our fund business as well.
I mean, the most attractive thing, like we were saying, is this is one of the rare instances where you can, you really can take fee savings, and that translates into improved returns. So, I mean, the more we can do that, the better. So,
Further questions on the co-investment topic? Okay, Jeff, I believe it stays with you.
Thank you, Mr. Chairman.
Or
I
with-
think you wanted to.
yeah, I'll start out. I will be brief. I think there is an over-under as to how many slides I actually get into before my comments are over, given my tendency to say everything. So I'll try to keep it. I will try to.
I'll take the over.
Yeah, I'm sure you will. The first thing that I'd like to do, Mr. Chairman, is that we're moving into the part of the discussion which of the continued discussion of the performance risk framework. And the first thing that I would like to do is I would like to recognize the work of James Wingo, Jeff Berg, and both Frank and Aaron from Makita on this project in the interim since our last meeting. They have worked very diligently to make progress on this framework. I think all of them would agree that this has been somewhat more of a massive undertaking than we would have initially expected. But I do think that what we will present to you today will generate an engaged discussion, and with the goal ultimately of driving towards consensus on some of the major decisions that we would have to make in order to adopt and implement this framework. At the end of this, discussion, there's no motion necessarily. We're really looking for consensus on some issues, but on as many of the decision points as we can, so we can keep moving forward. ultimately, what I would like to do is as we, we build consensus on all these points and we develop the links in the chain, what I would like to do is then take this and enshrine this into the SIOP, so it becomes part of our foundational document when we present a revised SIOP to you. So it'll, at the end of the day, all of this will be wrapped up into one package that we'll present to you. But I do, at the risk of sounding aspirational, I think that there is a good chance that we could at least reach consensus on the reference portfolio, and if not complete consensus on the policy portfolio, at least agreement that the simplified policy portfolio that we showed you back in February is a good place to start in regards to that piece of it. So without further ado, Mr. Chairman, I will turn it over to Jeff, and I believe he lost, because I believe that's on the under. So there you go.
I lost by a wide margin. Thank you, Mike. Let me lay out here the topics that we're going to spend some time with today. I'm going to start with, as Mike alluded to, a discussion of portfolio simplification. That's going to be part review and part laying out the vision there. I'll also share with you some of the early stylized examples of performance reporting. We made the decision, I want to say this up front because sometimes I forget to say it later on. We made the decision to not use actual numbers until we had time to test everything and make sure that the reporting that we're putting in front of you is accurate. So what we're going to show you are stylized examples. We want to start a conversation about some of our benchmarks. There's no recommendation coming today on that, but just to begin a conversation and sort of formally hand it off to Makita. Then we'll discuss the right timeframes for evaluating investment decisions. I'm going to ask both James and Frank to discuss aspects of asset allocation and what is the right level of risk for our plan. And then finally, as Mike said, we'd really like, because there's going to be a lot of building that needs to take place for this, we'd really like to figure out where we have consensus on these topics so that we can be building intelligently as we move forward. But Mike said this, I want to underscore it. We really do want this to be a good conversation today on each of these topics, so please interrupt me if you have questions. I'm very happy to redirect as you see fit. So in February, Makita showed us a path to simplifying the policy portfolio that I find quite compelling. Right now, our portfolio currently has 19 asset classes or sub-asset classes that have a target weight in the portfolio, 21 underlying benchmarks, and I want to be very clear, I've contributed to this complexity. This is not me criticizing anyone, I'm criticizing myself, if anyone. Makita's work suggests that we can simplify the target portfolio without reducing the portfolio's expected return, and B, that such a simplification could yield benefits in the form of risk reduction. So what does simplification really mean? I personally think of the policy portfolio as home base. When we, the staff, do not have an opinion to look different, that is where the portfolio should be. I do want us to have and retain a lot of the flexibility that we currently have to change the portfolio, but I think it's important to use that analogy of home base. If we are going to move away from home base, we should do so only if we expect an improvement in return or possibly a reduction of risk. And it's very important that we have the right framework to measure those decisions. So to me, home base, it makes sense for home base to be a simpler portfolio. If we add complexity and make that portfolio look different, there needs to be a burden of proof. We need to expect better returns. This is hopefully this looks familiar. This is what Makita showed us in February. Very quickly on the left is our current portfolio, 18 asset classes, cash not shown, making 19. In the middle, we basically just simplify that portfolio on the left one step, and it becomes 11 asset classes in the middle. And on the right, we distilled it down even further to the 5 major asset class groupings, plus Portable Alpha, which we will talk about in a few minutes. On the bottom, toward the right, you can see that the portfolio on the right is equal to the current portfolio from a return perspective, but is projected to have lower volatility.
Could I ask sort of an operational question about how this would work? If all of the sub-asset classes continue to be included, why are the returns different with a simpler mix?
So I will defer to Frank, but I'll take a stab at it first. So the return improvement is going to come from the elimination of certain strategies that, and I think that it would simplify, correct me if I'm wrong, Frank, to the reduction of credit as well as the elimination of GAA as a target for the portfolio. So that improves return, and then as you're hollowing out the risk by the reduction of credit, you're hollowing out certain risks in the portfolio and restoring them into an asset class called bonds that has, think of that as more core oriented. So what you're seeing there is a reduction of risk from the reduction of credit, an improvement in return from what Makita feels is a less efficient asset class in GAA. Am I making it?
2/3 of the way there.
Okay, all right. Well, I'll let you bring it home.
The other things, Mr. Chairman, when we model going from the far left, you see the U.S. developed EM equity weightings. That doesn't reflect a market cap weighting. It essentially is an overweight to emerging markets. When we switch to global equity, we're essentially using a market cap weighting. Why that matters is we have a higher risk and return assumption for emerging market equity than we do for developed U.S. and developed non-U.S. So that change brings down the risk and the return. The other thing, if you look at sort of the orange sections, the real estate and the infrastructure, we're taking out the public pieces of each of those, public infrastructure, public real estate REITs. Those are just by nature more volatile than the private market side of it. So that also brings down, just by taking those out of the benchmark here, the policy, that brings down the volatility as well.
Would you just repeat the last thing you said about taking out the benchmarks?
Just by taking, so if you say for real estate, if your benchmark is just going to be a core real estate benchmark, so the NCREIF Odyssey, for example, that is going to be less volatile than public REITs. REITs are traded on public stock exchange, so they exhibit the same kind of volatility as really small cap stocks, usually. So by taking those out of the policy portfolio, that's going to reduce our expected volatility and really your observed volatility if you were to take REITs out of your portfolio.
So am I right in hearing you all say that the portfolio does change somewhat? The details of the portfolio do change somewhat as we simplify.
Well, I think, and I'll step on Jeff's toes here. I think it depends on the implementation. I think he's still going to have the ability to invest in REITs, to invest in public infrastructure, to overweight emerging markets, but it's staff's choice. And as he was saying, he like this would be sort of home base, through the, and this is something he's going to get to later in this conversation, through the selection of benchmarks and weightings that you assign to those benchmarks. You're basically saying, this is where we want your default position to be, but you're allowed to vary around that based on some ranges around that too.
We basically, so think of the left-hand side as the available investments. We can give them all weights and enforce or ensure that that the portfolio is invested across, 18, 19 asset classes by assigning them all target weights. Or we can have a simpler home-based portfolio, and should we use REITs, equity options, that's a decision that we make to step away from traditional implementation, and then we measure whether or not that has brought value or risk. We measure for both.
I think what you'll see is practically the way that that's accomplished, and this will be in a couple of slides, is that on some of these kind of where your range or your target is 1%, they go to 0. So you're not required to have that. We're not required to have that level of diversity in the sub-asset. What would then become a sub-asset class? But it's available, but it's not a requirement, so that you don't end up forcing yourself into this level of complexity. So,
Becky, you have a question?
So I was just trying to understand, the simplification makes a lot of sense, and it makes a lot of sense for staff to be able to evaluate your decisions to deviate from that simplified benchmark. But what I'm trying to understand is if you do make that decision to, say, invest in REITs, do you have then the ability to benchmark that REIT portfolio at the sub-asset so you can still manage those individual investments and those decisions outside of the simplification of the
Yes.
small number
The
of assets?
reporting has to address that issue. And I'm torn between whether I jump forward 15 slides right now, or if can we come back
We
to
can,
that?
we can come back. I was just trying to understand how that process of,
Yes.
of evaluating the individual decisions and investments would
Yeah,
play
and
out.
that section that follows this is reporting, but if you recall the framework, there are 4 benchmarks across the top and then 3 measures of the differences between those benchmarks that outline what is the value during a period of time brought by that. So should we move away from real assets and the benchmark that the commission ultimately sets for that portfolio, and we invest in REITs, in the implementation benchmark, that is captured. So it's each strategy that we have using the benchmark for that strategy, so that flows into the benchmarks that we use in order to assess the quality of investment decision-making. So that'll make more sense when I actually have the graphics on that, but we'll make sure we come back.
Mix A versus mix B, are those two options we have to we either want to, when we simplify, we can either simplify it to mix A or we could simplify it to mix B?
That was the concept, was at what level would we want to move toward a simpler portfolio?
Right.
But what you'll see throughout is that what we've used to model is mixed, like especially when we get into the asset allocation.
We're using
Yeah, we're using mixed B,
Okay.
just because it's the most simple version.
Right.
So.
And so then, and the chart at the bottom is telling us that based on the simplest, all of our diversification away from that simplest is giving us an extra basis point in expected return and an extra 0.7 in standard deviation. Is that
Yes,
and that's
yes.
the primary targets we're using?
Yes.
Can I just, on the simpler mix, I mean, I know you're rolling the mixed credit and the emerging market debt up into the bonds, right? But, I mean, those traditionally are kind of high yield asset classes. I mean, I personally think, I know you're trying to distinguish private versus something, but at the end of the day, it's really credit and rates. At the end of the day that you're playing, I mean, to a degree, emerging markets is a little bit more, rate driven, right? If you're playing sovereigns, but, I think mixed credit probably ought to be more grouped in that private equity from a modeling standpoint. I just don't think it's gonna behave the same
Yeah,
in terms of your bands and things like that. I'd push that forward the other way.
So, and I'm putting you on the spot, Frank, do you remember what was used as the bonds benchmark? Was it ag or universal?
I believe that was ag.
Okay.
Yeah, so that's an investment grade benchmark, but you're pushing mixed credit, which is not
Yeah, so,
investment grade.
and that's a decision that you'd have to,
Yeah.
I mean, you would see that show up in risk too,
Yeah.
frankly.
Yeah.
Because you can't put high-yield bank loans in an ag portfolio and
Correct,
pretend that's the same risk.
right.
And that's an important part of
So
the,
I would just say bump up what you have for private debt or credit. I'd bump that number up and take the bond number down. I'd just push them to different categories for modeling purposes.
And maybe just call that private debt, just call that credit.
Credit, yeah.
so, this is the current portfolio. And what I've done here is I've added the allowable ranges that are currently enshrined in our governing policies. And those are on the right-hand side under current range. Of the 19 asset classes, as a reminder, 6 of them have a target weight of 2% or less. 9 have a target weight of 5% or less. So let me just juxtapose this granularity with what the simple portfolio would look like. And aside from just being a little easier to get your arms around, by virtue of being 6 asset classes, when we consolidated, because we don't have a formal bonds category right now. So how did I build the current range? That is just adding up all of the minimum and all of the maximum ranges. But that produces a level of, the constraints are just a little wider, I think, than would be appropriate. So the proposed ranges for public equity and bonds are shown on the right. We actually would suggest, being tighter than what it would currently be allowed under the existing portfolio. And again, for any asset class that is currently in our portfolio that is not explicitly named here, and that would include things like equity options, real estate infrastructure, mixed credit, EM debt, GAA, et cetera, we would like to preserve the ability to use these asset classes subject to their current upper limit in the portfolio. And when these asset classes are called into service, our reporting needs to make abundantly clear both A, what we have, and B, whether it's working to have it. And a final goal, we are currently still in the implementation phase of our new risk system. It is not fully functioning at this point in time. We are getting very close, but a 2019, 2020 goal is to develop the risk reporting that would overlay all of our communication on performance and allocation. So I've pulled this slide forward from James's presentation and removed some things, so you will see this in a few minutes. Again, let me orient you very quickly. Volatility runs left to right, lower risk on the left, higher risk on the right. Expected returns run vertically. Right now, our current portfolio is the dot on the right, is expected to be the dot on the right. This is assumption-based. If we simplify the portfolio in the way outlined by Makita in February, only we don't use portable alpha, we would become the dot farthest to the left. If we simplify the portfolio but continue to use portable alpha, we would be the dot in the middle. The middle dot does have the same expected return, only 70 basis points reduction to volatility. This is why I think this is important. There's a finite number of low-cost ways that we can move left without moving south. And that's why I think this is something that is worthy of discussion here. So let me pause there before I move into reporting, because that will be more of a sea change for the conversation. So let me pause there and see if there are questions, comments concerns.
Just curious, which expected return numbers are we using?
These are Makita expected returns.
They're different than the 10
James
years. that
stepped
you-
out.
They're different than the 10-year that you showed on the previous
So,
slide.
well, there was 10 and 20 on the slide back here. I outlined the 10. 20 is 804, 804.
So they just seemed higher than those on the chart. I
Oh,
was just wondering
oh.
if you were using 1 year or
No,
something.
I'm sorry.
different.
So this is, James, I'm getting into methodology here. James stepped out for a second. This is arithmetic, whereas the previous slide, the table is geometric. If you have a question on that, I would love for Frank to answer it.
You're talking about means, geometric mean versus,
Yes. So
Arithmetic
the
mean.
arithmetic mean is gonna be a higher number than the geometric.
Okay.
So I believe that's what James was using here.
So which one do we typically use when we look at expected?
Geometric. When we go through S allocation, we're typically looking at these tables, and we're looking geometrically.
Okay, but on the chart, we're gonna look,
Yeah, on this chart, it's
Different.
arithmetic.
okay. So if we did geometric, it would still have the same pattern, is that correct?
Yeah, I think that's a focus more on the relative positioning than the absolute
Right.
number.
Yeah, and I think it's probably a good time to remind that as we go through this, the placement of dots and diamonds and those types of things as we move through, it kind of portrays a level of precision that doesn't necessarily exist. So, because all these numbers are based on assumptions. So I think when we think about this, it's how do we move directionally rather necessarily than to think that there is whatever we're looking at corresponds to a precise actual number.
Yeah, there are assumptions regarding return and risk of each asset class, but then there's also very important assumptions at the heart of it that are how do the asset classes interact with each other and the correlation and covariance stable. There are a lot of assumptions here, and I'm sure Frank has guaranteed me that these are going to play out exactly this way. This was the subject of our dinner last night. I'm being facetious, for the record, Frank made no such promise.
now is it true that the importance of portable alpha involves an assumption that short-term rates are gonna continue to be about where they are now rather than, rather than inflation kicking in and driving up short-term interest rates?
So, no, but very close. The attractiveness of portable alpha, to me, is that, and we'll show this later on, because of where rates are and expected returns for asset classes are, the efficient frontier is fairly flat. So what the challenge there is getting appropriate compensation for taking additional risk. And if you think of it that way, the attractiveness of portable alpha is it is more of a vertical move than if you were to just move out on the efficient frontier, that would be more flatter. So is this tied to, how does this tie to rates? Frank and I have talked about this, and I'm passing off Frank's intel as my own here, so I'll praise to Frank. Long-term interest rates are low. And if they rise, not only does that create a different utility function for fixed income in our portfolio, which I think is clear to everyone, it has the effect of steepening the efficient frontier. So that's when, what you like to see is if I take more risk, I get, well compensated for it. Of course, eventually, the return per unit of risk diminishes. So there is a nexus to rates. Short-term rates, in the mechanics of portable alpha, very important and very beneficial when they're low, because that lowers the bar. Because recall that portable alpha works when the hedge fund portfolio's performance exceeds that of short-term LIBOR rate. So yes, but there's more to it.
More to it,
So-
okay, thank you.
If there are no more questions at this time, I'll move into the reporting discussion. So as we discussed at the last meeting, we are working to reframe our performance reporting around the basic investment decisions that we make that ultimately contribute to the plan's performance. I think I was very clear last time, this is what I need to see so that I can have, improved understanding of what's happening, how is it affecting the returns. And I need to have this, and I see no reason why this is not something that would benefit the commission in its oversight function. So I'm very happy to build this for both of us. So on that note, and in part because Mike left them out, let me pay a very big compliment to our reporting team. This is a tremendous undertaking for them to construct a brand new way of showing the impact of these investment decisions. They are very excited by the challenge, and they have brought to bear tremendous resources and enthusiasm in this. I'm very proud that they've embraced the challenge. When I talk with them about what I want to bring to the commission, I want to give you 7 to 10 really good, clear, concise, but comprehensive pages that will give you a improved snapshot of what is going on in the plan and how have we positioned the plan differently than the policy portfolio. So this is the principle at work. Good performance reporting should make it easy to find the right question to ask. So reporting may raise an issue that we will all see, and that will be how we know to address it together in the commission meeting when we talk performance. So I hope this looks familiar to you. To summarize, we're creating the benchmarks in the top row. Each benchmark is intended to capture investment decisions of a type. And once we have these benchmarks, we can evaluate the performance differentials between them in order to isolate the performance impact of the investment decision making, and these are shown in the second row. So let's take a quick look at a stylized example, which hopefully it's not lost on you. I tried to roughly follow the same pattern on the page. Let me describe here what this is. The middle section here, this is my attempt to make it very easy to find the top level conclusions on what is working and what is not working. It's 1, 2, 3, diversification, portfolio structure, and manager selection. These are the decisions we make. This is a slide I believe everyone has seen before. This is we call this the quilt chart. And the thing that we've amended here is we've added the reference portfolio, which, as you recall, is the simple 2-asset portfolio. And we have the policy benchmarks, so you can see those two relative to each other over time, but also the high-level asset classes that kind of pull these up and down. So we have just made modest changes to this. This is where we get into a little bit of new territory, and this another stylized example of the performance. This here shows us the performance impact of portfolio structure decisions. These are the decisions we make to look different than just following the policy portfolio. Not real numbers. Please don't get hung up on finding value that is there or not there. This is all stylized, made up numbers. But the heat map colors are intended to help you very quickly find the thing that is interesting, and you will see it, we will see it, and we will drill down on it. So I don't have the drill down layer to show you today, but there are two For portfolio structure decisions, there are two types of decisions that are captured here. We can choose to be underweight or overweight in an asset class, and we can build that asset class differently than the benchmark. And I want you to be able to see the effects of these. This is showing you 3 years of quarterly on the right-hand side inside the green dotted box. But imagine that also showing you monthly as we accrue months toward a fiscal year. We would have another version of this that would show you that. This page uses the same heat map approach, but shows you the implementation decisions. So think of this as showing you how well our managers are performing, rolled up. And David King already does a good job of showing us this. This is just a different way of looking at it. These are, again, stylized numbers, but if they were real, this would be a guide to really help the conversation about the quality of active management in the portfolio. So I'm trying to go efficiently through this. And now on page 64 here, this is a simple look at portfolio allocations. On the left, we would see the simple asset allocation, 6 asset classes plus cash. On the right, you would see us break these out to show you overweights and underweights at a more granular level. I've included here in the public equity breakout that is on the top right, U.S. equity in the form of equity options. If we move to a simple portfolio, perhaps that is not in the benchmark. Therefore, it would have a 0% target. But if we used it, I would want you to see that we had 4% in that as a way of implementing the public equity portfolio. Again, I don't want simplification to equate to a reduction of information to you. So we show this so that you can see the portfolio's current positioning. We repeat the same for bonds and real assets. Down here, I'm showing you other asset classes. These are asset classes that would be, in the case of GAA and other opportunistic, we would show you the exposure in equity, up in equity, but I would want you to know that some of that exposure was coming from a multi-asset class investment approach. So let me pause there. I try to get through that as efficiently as I can out of a sense of mercy. But let me pause here on all matters reporting and see if there are areas you'd like to have additional discussion on. But hopefully what you see is we're trying to if we use a simple approach, we're trying to find the right way to show you the decisions that we've made to incorporate more complexity than the simple approach.
Okay, could you go back to the reporting template, the owner's manual slide? Yeah.
This one? Yes.
That one. Just to make sure I'm getting this right, there is a reference portfolio, which we're going to talk more about later. And then the portfolio called the policy benchmark.
Yes, sir.
Is the simplified portfolio we've been talking about?
That would be, if the commission wants to move in the direction of simplification, yes.
Yeah. So that would, then the value added between those two is going from a 70-30, for example, to a simplified, more complicated portfolio, and then going to the third, going to C would be the simplified portfolio incorporating how it's implemented. Is that what implementation benchmark means?
Yes, it would be what, so think of the portfolio be the policy portfolio. It would, let's go down the path of a simple implementation. That would be the simple portfolio that we would set as the policy portfolio. Now, the implementation benchmark shows you the portfolio as it is actually implemented. So if we use a more complex approach than that, so if we have equity options, I want you to see that step in the chain. So let me give you an example of what I mean there. So let's say global public equity returns 8% over a period of time. Equity options returns 6%. But the manager that we've hired to implement equity options earns 10%. So what I want you to see in that chain is we made a decision for how we would structure the portfolio that actually hurt the return. And then separating that, so that would show up here in quality of portfolio structure. That is simply the difference between this implementation benchmark and the policy benchmark. As we move to the right, the commission is setting a static portfolio that in theory should be steady over time. But we will actually have a portfolio that is a bit more dynamic than that. And we can choose to incorporate additional tools, but we need to show you whether that additional flexibility is adding to return. What is the impact on risk? These are the things that I want to see and I want you to see. So back to the example, if the not S&P, but well, let's use S&P for stand-in for equities. The S&P earned 8. Here we earned 6, but the manager earned 10. So what does that look like? Quality of portfolio structure would be -2%, and the quality of implementation would be +4%. So -2 +4 nets to +2, and that would be the difference between what you would expect from that part of the portfolio in the policy benchmark to what has actually happened in the portfolio. So we're trying to just build a chain that takes into account each incremental step. And that's the goal.
Yeah.
I hope that I'm articulating it
Because
clearly.
in the current way, the only thing that you would see is you would just see the +2. But you wouldn't see the value of, because it'd just be policy benchmark versus the actual return, so you would only see the +2. This way, you get to see the fact that from a portfolio structure decision-making, that didn't necessarily play out, but the +2 comes from the fact that the manager outperformed. So the manager selection piece was what contributed to the outperformance, not necessarily the portfolio structure. So it gives you a deeper layer look at where either outperformance or underperformance is coming from relative to the policy benchmark, rather than just lining up the two and comparing them to each other with nothing else for reference.
So, and if we go to a simpler portfolio, there is, I think that the reporting on the implementation benchmark, the risk of that, and candidly, this needs to show you how the implementation benchmark is different than the policy. So that's what a lot of this is set up to try to do, is to try to fill that void of you know, this is different than this, how and why. So we're trying to build the context for that and show you exactly how that portfolio looks different today than the policy benchmark, and track those impacts over time. Because frankly, if it's an investment decision, it should be measured and it should be judged. So that's the principle behind this. Other questions? Okay, so, well, before I move on, I'm gonna take one thing from here. So we have timeframes here, but, and historically, we've focused all of our performance discussions on fiscal year to date. And as we think about the shortcomings of that approach, In September, we're talking to you about the fiscal year, but in November, we're now just talking to you about 3 months. So we're losing that longer-term context. And that's something that I really want us to have some conversation about. So I think we need a healthy discussion about what is the right time frame over which to evaluate different decisions. And I'm going to ask Frank to chime in a moment here, but I've thought a heck of a lot about the notion of a portfolio that over decades performs very well, and perhaps that's even the optimal portfolio over a very long period of time. So we know ex post that portfolio worked, but what we don't necessarily think about is that portfolio can take us through some challenging times. It can take us through 3, 5, even 10-year periods of time where it doesn't look like the optimal portfolio. There would be times, even with a portfolio that over 3 decades you would know wound up being the optimal portfolio, but there would be times that you would be tempted to change course. Because nothing, we all know this, but I'm going to say it nonetheless, nothing is going to work all of the time. So thinking about how do we balance the competing interests of having a appropriate oversight function on performance matters, but avoiding what can become a temptation with short-term kind of perspectives to be tinkering and moving away from a portfolio, because I think what happened, the temptation is to stop doing what you're doing and do what just worked. So I want to have a conversation about this so that we can be thinking about longer term time periods. What are the right time periods to assess the difference between the policy portfolio and the simple 2-asset portfolio? Because as we sit here today, we're at the tail end of and I'm going to call on Brian in a second here, but
We presume, too.
but no, this part we know. We have just gone through the best 10-year time frame for a 60-40 portfolio versus all other timeframes for that same 60-40 portfolio. In how many years?
Since 1970.
So
And US as well, rather than,
that's global.
is that
I
global?
believe it's a global 60-40. That's a global 60-40 portfolio, but it's outperformed by not just barely outperforming all of the other rolling 10-year periods. It's appreciably better. So, the temptation is obviously for us to say, well, diversification doesn't work. I think the classical, finance professor in all of us should be screaming at that statement. But, that's the temptation, is to say, well, nothing works but 60-40, and we should do that. So, but I think it's because we don't have necessarily an agreed upon time frame for how do we think about judging success. And I'm focusing on the value from diversification, which is that asset allocation decision, but it applies equally to our decisions that we would make to look different. We can look at month to month, we can look at fiscal year to date, but that doesn't encourage us to, when we see risk building and we see a way through it, or as in December, we see an opportunity to add equity risk to the portfolio. If the judgment period is going to be fiscal year, that's okay, but we're not gonna take up those decisions, that we would if we had, kind of an agreed upon 3-year period of evaluating those decisions. So, or we would take them up, but we would do them in diminished size, for fear of being wrong, and judged harshly. So, We're trying to, what I'd like to have is a discussion about what makes the most sense from a governance perspective for you all to look at the decision that you make about diversification, I think is easily the most important decision that is made. And then, I'm offering 5 years, and we can talk about that in a second. But then also, how do you assess the decisions that are more staff level decisions? And I'm comfortable with the 3-year timeframe. Of course, I'd love it to be longer, but that's just not really necessarily practical. 5 years for assessing the quality of asset allocation. Frank, your thoughts?
It is probably the only it's a good balance of being practical with what happens in markets. I mean, markets are clearly cyclical in nature, and some of those cycles can be very, very long-lived. And so, even like a 10-year time frame, again, this has been the best 10 years of U.S. equities that we've ever had relative to other asset classes. Yeah. Does that mean diversification's dead? I don't think so. But most of us in this room probably aren't going to be here over a 20-year time frame. So to be fair and be practical, then yes, I think you need to keep somewhat shorter.
I'm right here, Frank.
You mean on the commission, not necessarily on Earth.
You are correct.
When you say 20 years.
You meant it in the nicest possible way. For all.
Here in this room, yes.
So,
Unless you're with the retiree group.
we've talked an awful lot about this, and there are advantages to looking over very long time periods. Commissioners are now, serving 2 4-year terms, so we thought, okay, that's probably an upper limit. But fiscal year to date, I think would create a lot of temptation to make changes, annually, and we should recall last meeting, Frank sort of politely suggested to us that we're looking at changing asset allocation too frequently. So I just think that this is the straw man that we've talked about internally that I want to put before the commission as kind of the timeframes that when we talk about performance, that we make sure that we are incorporating a longer term perspective, and this is how I would propose we do that.
Mr. Chairman, I mean, we would still see, obviously on rolling periods, you would get the same information. I think it's just the longer of the time period that we can put more focus on and pay. I mean, I would suggest that even, the 3 and the 5 is, not necessarily long enough for either decision, but the more focus that we can, it's not that you won't have the information, it's just the more focus that we can put on the longer term values of these decisions, I think the better. Again, understanding that, there's a practical limit to it at some point.
I'm gonna, in 20 seconds, make it so I don't have to go to the next slide. Our notion is that we would spend, when we have fiscal year performance, we would use that as an opportunity to look at longer term performance impacts. Also calendar year, so twice a year, we would, instead of doing fiscal year, we would focus on a longer term perspective, still provide all of the information, but the column that's highlighted that we are talking to would be a longer term performance figure. But the other meetings, we don't want the conversation to be looking at something that is very slow moving in 3-year terms. We think it's also very important to be in the present and talking about what's happening in the portfolio as we do customarily currently. So the notion is we figure out what time periods do we want those long-term time periods to be, and then we start kind of alternating those into the meeting for the perspective long-term performance. Not that we extend the performance discussion and talk about both every time. I think alternating would be
It's alternating the focus.
a potentially preferred way to go.
Let's see, would anyone like to suggest a break at this point? Or should we continue for another half hour or so?
Break is good with me.
Okay, yeah, it's almost the hour and a half point, so, what do we do, 10 minutes usually? 10-minute break at this point, so that'll have us coming back at 11:05. Okay, looks like we're back. Jeff, is it back in your hands now?
It is, Mr. Chairman, thank you. The next topic that we just wanted to have a short conversation about, and we can come back to this at the end, is Portable Alpha. So Portable Alpha is a way of implementing an asset class exposure. It is not necessarily an asset class unto itself, but it is something that we've always felt is important enough that we should treat it a little bit differently and make sure that we're clear on how it is doing. So the question that I have is whether or not Portable Alpha should be a part of the policy portfolio, or in the performance framework that we've outlined, is this something that should more appropriately reside in the implementation portfolio? So I think that this is an issue that boils down to a pretty basic question. If the commission wants Portable Alpha in the portfolio and wants to tell me to have it in the portfolio, if that's the kind of the feeling, then yes, it should remain in the policy portfolio. If the commission would rather I make that decision and establish an allowable amount of Portable Alpha that can be used in the portfolio, then I think that moves over and should be something that is very clearly my responsibility. I am responsible for whether it is there. I'm responsible for the outcomes over time of it. But that would move it out of something, out of the policy portfolio, and it would exist in the implementation portfolio, the implementation benchmark, as opposed to the policy benchmark. I am indifferent to this, but we've had conversations, and I think that this is an area where we should have the discussion and have clarity on who should own the decision about whether or not to have Portable Alpha, and then we allocate it into the right benchmark, so that we can have the appropriate kind of performance reporting on it.
Jeff?
Yes, sir.
To make that decision, maybe you could elaborate a little bit on how you presently define Portable Alpha and how you've been using it in the last few years.
Sure. So we have been using Portable Alpha since July 1st, 2016. And I should note that it was a feature of the portfolio until, I believe, 2012. So what Portable Alpha is the marriage of a beta source, and in this case, I would have you think of just an S&P futures contract with an alpha engine. So think of the alpha engine as being either a hedge fund, alternative beta strategy. Think of that as a lower cost hedge fund, but something where you have. Let me articulate how it works. So you have the S&P futures contract. If that is the only thing you have, that and an amount of cash equal to that futures contract's notional value, you will earn the return of those two things, of the futures contract and your cash. You will earn a return that is equal to the S&P 500. So now the question is, can you do something with your cash to earn a better return? What we don't want to do is have an S&P futures contract backed by private equity, or backed by public equity, or backed by another beta in the portfolio. So a hedge fund is an alpha strategy. So what you should wind up with is the return of an index, the S&P in this case, plus, and our target right now is 2.5%. So the combination of the portable alpha hedge funds and the synthetic exposure to a beta in the portfolio should, over time, deliver you a return in excess of, in this case, S&P plus 2.5%. So that's what we have. That's why we have it. We have used portable alpha in roughly 10% of the portfolio, and we have Brian Moore has done a great job reducing risk in our portable alpha program. That I'm not prepared to get into. I don't have any charts outlining this, but he's done a wonderful job taking risk out of our program so that we don't have a kind of a levered effect here or a liquidity effect that comes out of the portable alpha program. So we feel really good about the changes that he's made. Over time, our hedge fund portfolio has done better than this. This year is a bit of a tough year for us, so portable alpha is not adding value as of today in our portfolio this year. But over time, this is something that has worked very well for us and has added a lot of value to the returns. And we should also note that there is an actuarial impact of portable alpha, that the actuaries have sort of assigned a value to portable alpha separate and distinct from kind of the regular asset allocation of the plan, and the credit that we have gotten for that, actuarially speaking, is, I believe, 25 basis points at the plan level from having it. So you can think of it as, and this is part of what Dr. Wilder was asking about, is there are very few things that go well with low rates. It's harder for us to earn the actuarial rate of return. This is one of the few ways that we have turned low rates into a strategy to deliver better returns. So bond portfolio is certainly not pleased with low rates. And that creates a challenge for us. We can't have it's very different than if you have a treasury curve that goes from 4% to 8%. That creates a much simpler environment for us. And that's sort of when we think about how to react to low rates, this is one of the ways we're doing it. When rates normalize and go back to what we think of as the classical level of rates, I think that it reduces the attractiveness of portable alpha.
May I try to speed this along a little bit?
Please.
My fellow commissioners, is there anybody here, or do we want to start a conversation on, do we want to move this to an implementation benchmark and take it out of the policy benchmark, or do we want to leave it the same?
Here are kind of my thoughts on it, right? I think people externally will look at that policy benchmark more, and I'm not sure they're going to understand the term, right? But I do think it's important to measure because it's effectively a leverage factor, right? I'm a little bit split on it
There
because of that,
cases
right?
to be made on both sides.
It's something that you definitely need to see and understand the impact of.
Yeah.
But it's also not something that necessarily needs to always be on either, right? Especially if you're thinking about a policy portfolio over a much longer period of time. I mean, your rate environment's going to not necessarily be favorable to that.
My gut tells me to keep it out of the policy portfolio just because I think it's opening a can of worms.
Well,
it seems to me to be a tool, not a policy.
Right.
Exactly. Is this something, or no matter what level it is this something that needs to be on all the time? That's my question. And I think the answer is resounding no,
Yeah.
right?
For 30 years now.
Okay, so if that's the case, then I think we take it out.
Yeah.
Right?
Mhm.
All right. So what do you need to make it,
No, I mean, if there's consensus, we're good. I mean, that's it, that's the.
Yeah, we don't need a vote or anything.
we don't
We
need a
just
vote.
want to know
Yeah.
if there's, if there are opinions that differ. But I mean, to be clear, right now, it is in the policy. And
well, it's on right now, and I think we've all agreed.
Because we don't have
that
another benchmark.
It doesn't need to be. And is everybody okay with?
So the question is, I mean, the motion would be that it should be left out? Is that your?
I think the motion, if we're making such, is that make it the CIO's decision.
Yeah.
And it comes out of the policy benchmark and becomes a component of the implementation benchmark.
Comes to the implementation.
And just to be clear, we're not, again, we're just looking for consensus. Like, all of this will be, you'll get another look at this and to formally adopt it. So as long as there's consensus, that gives me the direction that I need to make sure that the SIOP reflects.
Well, in the simplest form, I think we are in agreement that this is something that does not need to be on all the time. But right now, it is.
Yeah.
And so I think that's a constructive change.
I'd agree with that.
Yeah, I agree.
That's good feedback for us. Thank you. Thank you. There is nothing asked here, but I want to make you aware that I have asked Makita to explore for us, especially for your consideration, some different approaches to benchmarking private markets asset classes. And at the highest of high levels, what do I mean? Right now, all of our benchmarks are public plus a spread. And I've asked that we explore universe benchmarks. What do I mean by universe? I'm not talking universe of our peers, but what does the universe of private equity give you in return? Why does this matter? This is something that I want to explore as a way of improving the information in the performance reporting. And if the example I'll give you is if public equities earn, we'll go back to 8%. Private equity as an asset class, if you just kind of generically invested in private equity, let's say that got you 15%, that would be 700 basis points better. If we only made 12, we would look like we are outperforming, when I think the reality is that you would find that is a suboptimal implementation of private equity. So what I would like to explore is whether or not there's in any of our private asset classes, as well as frankly with the portable alpha hedge funds, is there a universe approach that would make more sense? This is something that I've asked Frank and Aaron to begin working on, with the notion that we would have a discussion on this topic in September. I don't want to rush it. And it will be Makita's opinion. I'll give him my opinion, but this needs to be Makita's opinion because candidly, I should not set the benchmarks. That is the work in progress. If you have questions or ideas or would like to see something explored, I would ask you to let Frank know so that he can incorporate that into the work that's getting done.
And we're going to give you a preview of that in a few short slides a little bit later on this meeting.
So that brings us to the most meaningful topic of discussion today, that James is going to guide us through a lot of the work that he's done, and he's done a lot of great work. But before I turn it over to him, I have a couple of points I'd like to make. I know that we all understand that determining asset allocation is far and away the most important investment decision that gets made. There are a number of factors that have gone into the work that James is going to show you here. And we've looked at risk factors, we've looked at practical considerations about funding the plan, we've looked at funded status, we've looked at an array of things that he'll outline. And one of the main conclusions of our work, I want to be clear up front, is that the policy portfolio we have is good. There is nothing that you should not feel that this is something that because we're looking at it, we have to make changes. I think James will paint a picture that this is, we are in really good shape, frankly, with the asset allocation that we have, and he'll show you, one of the things he'll show you again is the effect of shifting to a simpler implementation. So I want to briefly revisit the framework just so that everyone would be anchored. And Reynolds, we're on page 70. The reference portfolio is on the left. That's the 2-asset portfolio. The policy benchmark is, I think we all understand what that is. And the notion here is that those two would have the same level of volatility on an expected basis. And so we would see the improved return from diversification, not from differences in risk levels. So the important thing here that we wanted to talk about today is not only the policy portfolio, which we've done a little bit, but what is the right risk level for both the reference portfolio and the policy benchmark. So let me have James guide us through the next several slides. Take that.
Yeah, so thanks, Jeff, for laying that out. I think, the most important objectives today for us are to hopefully arrive at consensus, as you mentioned, on three really key things here. One, to understand what the appropriate level of risk is for the plan, but in other words, the reference portfolio, but more importantly, on understanding the basis for that level of risk and how we're positioned, and what are all of the factors that we should consider when setting that level of risk. So also agreeing on the rough objectives of a simplified portfolio and the appropriate directional goals if we want to look at any potential changes to that, and then specifically how different changes that we would make to asset allocation would actually impact our position with respect to our goals, and also what those trades would look like from an asset allocation perspective. Before we set the portfolio's level of risk and return, we should understand the key risk factors that we want to use to assess the portfolio's risk and return and the appropriateness of a given risk return target. So we've talked about these a few times, and we would offer 4 key factors that we should consider about our plan to think about in terms of risk and return. One, maximizing our probability of meeting or exceeding the plan's assumed rate. That is tied to a lot of goals with the plan with respect to meeting our goals from a funding status perspective in a long-term basis. And so we want to also maximize that probability of achieving full funding within a given time period. So contribution rates are another factor that we should consider with that too. Specifically, we want to minimize the probability of having to actually go back and raise the contribution rates on active members in the system. And we can measure that objective as well. Also plan tail risk. We obviously want to avoid certain catastrophic plan outcomes. And we'll talk about each of these risks in a moment and how we can actually translate each of these sort of risk factors back into how they impact our risk return preferences. So first of all, let's sort of layer each of these risks on one by one. First off, we'll talk about the assumed rate. If we layer on the assumed rate in sort of this arithmetic risk return space we're looking at, we can see the impact on the types of portfolios that we should choose. we should only choose portfolios that lie above the red dotted line if we want to exceed the plan's assumed rate. And most importantly, this impacts the directional movement that we should undertake with asset allocation. We should ideally position ourselves, if this were the only risk that we cared about, we would ideally position ourselves as far above that line as we possibly could in order to maximize that probability. Now, there are other risks, however, that impact our risk-return preferences in different ways. So, yeah.
Could I just ask why that's not horizontal line at 7.25?
Sure, yeah, great question. This goes back to, Rebecca, your point earlier as well. So when we look at the output of a mean variance optimization, which is what we're looking at here in risk-return framework, with risk shown as volatility on the left to right, and then the up and down axis showing the return. What we're doing is we're looking at that in arithmetic return to get back to a geometric return, which is sort of your realized compound return over time. What you need to get is actually a higher arithmetic return in order to get that. So what the upward sloping line is actually illustrating is the cost of volatility in terms of your expected realized compound return over time. So this geometric line, or this arithmetic line, what you can see here is at roughly a level of risk of around 13, you are at a point here where this exceeds 8% arithmetic expected return. That actually, if you were to take this all the way back to 0% volatility, that goes exactly to 7.25, which is our plan's assumed rate. So this is illustrating the cost of volatility. And we need to take that into account when we consider a plan, particularly as ours, where we have negative cash flows coming out of the system. That also increases what you call the path dependency of your outcomes. So it also increases the relative cost of volatility to any given asset allocation. So this is important to consider. It's also important to consider the plan's interaction of assets and liabilities when we consider the other risk factors that we'll take into account. So because the other risk factors have a different impact on the plan and affect your risk return preferences differently. So we want to illustrate that. What we'll show here is the other risk factors we consider. One, with respect to the funded ratio. If we were to model the objective of achieving a full funded ratio within 30 years, how we would show that impact on our risk return preferences would be a line further out here. The line that I'm actually showing is a line of the exact same slope, but what this line is showing is the objective of not raising or avoiding further contribution rate increases. Specifically over the next 5 years, what this line represents.
James, beyond what was approved in statute.
Exactly, beyond the 2017 legislation, which actually provided for a conservative path of contribution rates over the next several years. So what we certainly think is an important objective to achieve is to not have to sort of run a portfolio that has a level of risk that runs a material probability of actually causing those contribution rates to go up. So what this line represents, and it's really a conceptual line, and the slope of the line is what's important, because what it represents is portfolios that lie to this side of this line are portfolios that from a risk-return perspective run less than a 5% probability of actually causing a contribution rate increase over the next 10 years. Portfolios that lie to the right side of this line are portfolios that actually run a probability that's greater than 5% over the next 10 years of causing a contribution rate trigger. So this is a concept, and the thing that's interesting about the line isn't so much the particular location, it's how does this affect your risk return preferences? So if the funded ratio and the contribution rate increases are the only things that you care about on the plan, what you would be incentivized to do is to move directionally as far away as you can from this line. Now, we're showing this sort of infinite risk return space here where you can move forever to the northwest, which is obviously what you do. When you layer on the efficient frontier in a simplified framework, what you get is an understanding of the limits of what you can do. So in short, if you were to sort of translate these objectives into how they affect your preferences, if all that you cared about here was raising contribution rates or achieving you're given funded ratio with maximum certainty, you would be positioned, and you wanted to be on the efficient frontier, you would be positioned right here. On the other hand, if all that you cared about was achieving or maximizing the probability of increasing your assumed rate, you would be positioned up here on the efficient frontier. And also we'll layer on another factor that we could consider here as well. If you look at the peer.
Tim, just one second to make sure that there's clarity. Your efficient frontier is comprised of the 5 asset classes that are in the simplified portfolio, right?
Exactly.
That Makita showed us. So it's basically the 5 that don't include portable alpha, because portable alpha really you can't model on an efficient frontier, right?
Yep.
Okay.
Correct.
Yeah. Just to orient us
Thank
to
you.
make sure we're all on the same plot.
Yeah, thank you. So what we illustrate here is the peers. So what we've done to illustrate how the peers might impact our preferences as well is to say, from an intelligence perspective, let's look at what our peers are doing. This is the 36 peers that make up our BNY greater than $5 billion public funds universe. And if we take Makita's capital market expectations and say, where do they fall on the risk return spectrum, this is where each of them falls. So the analysis here, I think, illustrates the challenges in part to pursuing a strategy that's solely centered around the peers, because on the one hand here, you have a number of peers that are pursuing extremely low-risk strategies that are below our assumed rate, that have a very low probability of exceeding that. And you see things like as much as 30% TIPS allocations with some of these peers, and you see things as much on the other side as effectively 100% equity allocations with certain peers. So if we were oriented solely around the goals of sort of the peer group, what we'd be incentivized is to be as far over here as we possibly could, which would be imprudent from, we think from a risk perspective when we consider the other risk factors that are important. So if we were to translate the peers to just what the expected median outcome or median return of those peers is, it would look like a line exactly like this. And that would further reduce where we would want to be positioned with respect to those peers. So, we'll illustrate that from an intelligence perspective. And show where those fall. But if you look at where you'd be positioned, as I mentioned, if you cared only about certain risks, you'd be here. If you cared only about the sort of funded ratio and contribution rate objectives, you would be over here. If you cared about both of them equally, you would sort of want to maximize your distance away from each of these risk factors that you would consider. And if you look at where we're positioned today with our current asset allocation, I'll layer on where we're at using Makita's capital market expectations for our actual portfolio today, and then the simplified version of our portfolio as represented by the Makita capital market assumptions earlier. And then if you layer on portable alpha to this as well, we would slightly exceed the efficient frontier based on this being a simplified 5-asset frontier. So the objective that we started with was to say, well, how should we go about thinking about what's the appropriate total risk for the plan that we should establish, and how does that slot into a stock bond framework if we want to set the reference portfolio? And what I show here is the relative positioning of different stock bond mixes from a risk perspective across our portfolio. This is sort of bookended by a 60-40 and a sort of a 90-10 allocation here that I show. And what you'll find is that roughly in between where our simplified portfolio would fall and where we're actually positioned, and it just so happens to be sort of represent the center point of our two critical sort of risk considerations, lies a 70-30 portfolio. So that, we think, for our portfolio right now is a reasonable representation of how we are implementing, how we're positioned, but then also where we would also ideally be if we started from a blank slate.
Have you estimated what the projected return would be on the 70-30?
Yeah, we do have that. That is relatively, that's somewhat below. I don't have the exact number of how many basis points below where our current portfolio is, that portfolio's expected return is, but we can get that to you.
Yeah, but it is lower,
Yeah, and that
current projection.
That, it is. Yeah, that varies based on different capital market expectations. Frank, I think you guys have, relative to, I think horizon-based consensus assumptions, you have a slightly, rosier picture for public market investments, which sort of brings that spread a little bit tighter, to your point. But, I don't know, Frank, you want to comment on your capital market expectations? But.
We have a table we're going to be walking through in a few minutes, Mr. Chairman.
Thanks.
So with respect to what we would consider, we show we're relatively close to the efficient frontier where we're at today. But what I show here is sort of the value proposition of different directional movements in a risk-return framework for our goals. What we show here that's interesting is if you sort of move in line with the peers to minimize your tracking error to the peers and increase your probability of outperforming those peers, you would move in sort of this direction. What that direction is doing is improving the probability of achieving certain outcomes, but it's worsening the probability of achieving other outcomes. And we wanted to illustrate that with these directional movements here. Obviously, the most efficient direction to move is up and to the left on this framework. But when you look at the actual trades associated with that, what you're undertaking there is essentially a shift. You can look at it as a bit of a barbell perspective in the portfolio, but also as a bit of a shift from public to private assets, because the simplest trades to accomplish that in a simplified 5-asset portfolio framework is reducing credit in favor of increasing private equity and real estate at the same time as increasing core fixed income. So we want to talk about, what the implications of that are. Obviously, that's a higher fee portfolio, and it's a less liquid and more complex portfolio. So wanted to, show what the implications of different directional moves are for our portfolio. But overall, I think the important takeaways from this framework are to say, hopefully arrive at consensus of saying what's the appropriate level of total risk we would take in the plan, and say, here's where we're positioned today. Here's, we think a relatively appropriate policy portfolio as well that's represented by our simplified asset allocation. And here, if we want to take a look at different directional moves, here's what they would be.
And James, just to, give another plug to our co-investment program that we unveiled today. One of the ways to move north from where we are is through co-investment, because you're getting additional return at basically the same risk.
Yeah, exactly. The capital market expectations here are based on fund investing in private equity, so co-invest is one of the most impactful areas to certainly change not the expected fees or risk that you pay, but the expected return that you have, which sort of moves you beyond this.
So it looks like we go from our current portfolio to the simple portfolio with Portable Alpha. We effectively are making one of those left-handed moves, reducing our volatility, but not really sacrificing much in expected return. How would that inform us for our next step? Does that mean we should move our portfolio to look more like our simple portfolio?
So I think that, in terms of assessing what we do as a result, it certainly impacts how we consider asset allocation, because what the capital market expectations that we have are telling us are that we're not getting a significant reward for the additional complexity that we're taking. It certainly would impact us to rationalize those positions a bit more. But I think to Mike's point earlier, some of this comes down to implementation as well, and where we can actually achieve advantages with respect to the in-place capital market assumptions. Because these are just assumptions based on the beta of the asset class. If, for example, in private equity, we have the ability to move that portfolio and actually improve the risk and return outcomes, that's a positioning that we're actually improving this outcome directionally this way.
So,
Yes.
so I'm
Yes.
just like, what you
Yeah, that's.
I guess I'm like, what are our next concrete steps for improving our portfolio based on this?
I think what you would, if I can take a stab at it, I think what you would see is that if you say, yes, this is a simple portfolio, this is as a commission, this is our policy portfolio. So, and this is ultimately the portfolio by which we are going to judge your implementation. And you would signal to us that a move towards simplification and trying to implement in a way that moves us to the left is where we should be taking, when we implement is where we should be taking the portfolio directionally. So, is that?
And I think you can start seeing a migration of the portfolio.
Yeah, right.
I mean, it
Okay.
can't happen
Oh, yeah, no, right, okay.
overnight,
I was-
quickly, but try to be thoughtful about
Right.
where and how to move that portfolio
Okay.
from A to B. But that's the only way it becomes real.
Right.
Just changing the benchmark doesn't move our portfolio.
Yeah.
So we
Okay.
start, thinking about the portfolio, the asset classes that we have, not as this is what the commission has told us to have, but now that has become an off-benchmark position, and we say, okay, do we like that? It's a different conversation.
But, I mean, go ahead and go to the next slide. I mean, that kind of prompted the next one prompted the question, right? I mean, this way, I do think before we push in a direction, we really have to spend some time on the assumptions, right? Because, core fixed income, you're basically, going to two actuarial-based asset classes, right? So some of that's smoothed out of the numbers. You got rates at historic lows. You got a couple of markets that don't even have a government bond market anymore. I mean, there's not one in Japan. There's not one in Germany. For a practical standpoint, maybe we're not going to have one here. I mean, these are real considerations. I mean, it's not a joke. It's $13 trillion that's not there. That's at zero. Right, and so private credit is the bond market if you're in those worlds, right, to a degree. So I think we gotta, when we do this, we do have to think through what's the world actually look like, right, now versus just how it comes through statistically, historically, right, and how do we adjust it for our forward estimates, right?
Yeah, and one of the challenges with that, to me, is we're looking at now, I mean, you're not talking about things that are ephemeral, they're gonna change in
Right.
5 years, but
Correct.
some things you look at, if we're thinking about a 30-year allocation, kind of 20-year allocation, these are big things,
Right.
without question. But, what do we look at and be swayed by the current state? And what are the things that we say, this probably doesn't rise to the level of affecting a 20-year allocation, I mean, central bank, this is big. I'm not disagreeing with you, but, valuation in equities, this is where I think we have to ask ourselves, how dynamic is the policy allocation? And that's a question without a real simple answer.
Yeah, I would highlight, though, as a function of that observation, I mean, I think one of the things that's advantageous to us to consider the asset allocation on this level in a simplified 5-asset framework is the sense that you pointed out sort of the big, problem with looking at mean variance optimization, that the mathematical process to get there is perfect, but the assumptions are where you get all of the errors. Now, to address the assumptions being problematic, reducing to a 5-asset portfolio is a way to cut through a bit of that, because when you look at a large, 17-asset or 30-asset sort of capital market expectations setting process, you get into a lot of compounding of errors when you look at the return vol and correlation assumptions that you're combining with respect to, EMD versus broader core fixed and investment grade, as opposed to a 5-asset portfolio where you're really minimizing the level of potential errors in the process when all that you're really needing to look at is the correlation relative expected returns and volatility of, equities broadly versus bonds, et cetera. So that's one of the things that we like, I think, from an analytical utility perspective of looking at the asset allocation in a simplified framework is you're getting around and addressing a little bit of those assumption errors.
That said, Frank did promise that all of the assumptions are flawless, so I think we're okay there.
And you're welcome to hold me to account for that in 20 years, our assumption period.
Yeah, sure. So, all right. I do want to, Frank has some slides on this topic as well that I want to move us into so we can be efficient here. I'll give you that.
Fantastic. Thank you, Jeff. And I'm going to move fairly quickly because I'm going to rehash some of the themes that Jeff has already talked about and expand on a few of them. The first is that a reminder of what we've been talking about with the different levels of benchmarks. What I really want to focus on today is the reference portfolio. And Mr. Wingo just walked us through showing how 70-30 really starts, looks like it's a good representation of where you are now. We've been having this conversation with staff for a few months now, and we think that, and really have to go back to basics here. Well, what is a reference portfolio? Most people think of, okay, just a stock bond mix is a good place to start. So what should those stocks be? Should it be just U.S. equities or non-U.S. equities? We settled on using global equities, so the entire really equity opportunity set, because it is something that represents the opportunity set for you. They are liquid, they're commonly invested, and they are risky assets. They're not the only risky asset that's out there. There's private equity, real estate, infrastructure, et cetera, but it is the most commonly invested risky asset, and it is liquid. So it makes for a very good benchmark. So we think that's what we use there. On the bond side, there's a bit of a debate. Do you use something that's sort of a broader opportunity set like the Barclays aggregate we talked about earlier, or do you use something that is truly risk-free like U.S. Treasuries? And I know, yes, U.S. Treasuries have interest rate risk, but the risks that are inherent in U.S. Treasuries are not necessarily those that are inherent in stocks, the other part of your portfolio. If you use something like the Barclays Ag, you're going to have mortgage securities and a lot of corporate securities in there as well. They're going to have the same type of risk that's very similarly related to equity risk. So we don't want to really double count that risk. So for purposes of the reference portfolio, we want to use treasuries. So essentially global equities and U.S. Treasuries as a reference portfolio. As Mr. Wingo pointed out, as of your current portfolio, 70-30 mix of those two things most closely represents the risk of that portfolio. Now the return is lower. Our return expectations was somewhere in the nature of somewhere in the ballpark of 60 to 70 basis points lower for a 70-30 than for your current policy targets. But the volatility was equivalent. Mike and Jeff suggested, well, that's where we are today. Frank, can you go back and look at, our portfolio over the last 5 years? Have we always looked like that? And so we took your policy portfolios, going back, even before we were working with the commission, to see, what would that, using our capital markets expectations at the time, so, our 2014 expectations in 2014 or 2015, 2015, et cetera, what would the reference portfolio have been that most closely approximated the volatility of the portfolio? And you can see that no, it hasn't historically been 70-30. It actually had been considerably lower going back 5 years ago. But for anyone who's been on the commission for that length of time, it shouldn't surprise you because over the last few years, the commission increased primarily the equity risk of the portfolio. And that has increased, what would be this reference portfolio. So historically, over the last 5 years, the average has probably been somewhere closer to 65-35, settling in on, where we are today, sort of the 70-30. So in a sense, this is, if you agree to 70-30, you're saying this is the amount of volatility that we're essentially, we as a commission are comfortable taking on. If you wanted to take on less risk going forward, then you would pick, a reference portfolio that has less risk in it, whether it's 65-35 or 60-40. What we're trying to get at today, to echo one of Mike's themes, is not a motion, but rather consensus around a reference portfolio going forward. Is it going to be 70-30? And that's where we in staff settled on. If you believe that where you are now with your portfolio is where you want to be with risk. So shifting gears a little bit, here I'm going to echo some themes that Jeff's made and that James made as well. First, we're just plotting, a sample, stylized version of an efficient frontier at the bottom here. And saying your portfolio, again, is somewhere near or on that efficient frontier. It may not be precisely on it, but very close. It's a very efficient portfolio. There's nothing where we walk in today and pound the table and say, you really need to change something. Yours is a fairly efficient portfolio. The next couple of bullets are something I'm going to get back to. Making frequent changes to your policy portfolio can be detrimental to long-term goals. We've seen that with other plans, and we have data we want to point to there. And again, your portfolio is fairly efficient as currently structured. Now, on the frequency aspect, you may recall at the February meeting, we presented a survey of best practices of other large state plans. And there were, I think, 15 questions that we included in there. And one of them was, how frequently do you make asset allocation changes? And less than 1/4 of them made changes on an annual basis. And most of them were in the 3-year time frame and really even longer time frame. So 3 to 5 years were the vast majority of plans. And that's kind of where we're trying to push you. And the reason, again, behind that is these are strategic long-term decisions. Staff, you're giving them the latitude to make shorter-term tactical decisions. So this page isn't exactly an efficient frontier. If the finance professors in the room, it more closely represents a sort of security market line. But what it's trying to get at is a couple of things. Number one, there's a relationship between risk and return. If you want to get higher return, you have to take on more risk. But again, they call it risk because it's not a guarantee of return. Number two, this relationship is not static. What you see here, these two lines, the blue line is what our expectations were 10 years ago, and the reddish line are what they are for 2019. And it's forward-looking, a 10-year expectation. And this gets to what Jeff said. This relationship, has gotten flatter. And this, again, it's on efficient frontier, but because of this, the efficient frontier has gotten flatter. You are getting paid less to take on risk than you were 10 years ago or even 5 years ago if I plotted that up here as well. And the other thing is this relationship is not known in advance. This is why we create assumptions, but as James pointed out, they're assumptions, they're not precise. We don't know exactly what the future is going to be. These are they're well-informed, well-educated, but they are, at the end of the day, best guesses. So here I'm going to get at some of what James was talking about in his presentation. If you're currently at or near the efficient portfolio, the efficient frontier now, there are really two ways to either move that frontier or move beyond that efficient frontier. So one way you kind of move the efficient frontier is by including more asset classes. So if you're using a simplified efficient frontier, so a 2 asset class efficient frontier, it's going to be lower and to the right compared to an efficient frontier that includes all available asset classes, all available strategies. And in particular, if you try and use asset classes that have a lower negative correlation to them. So when you're looking at portfolio construction, the inputs we're usually looking at, you're looking at expected return, expected volatility. But the third thing that's usually buried in an appendix somewhere is that covariance matrix. That is the relationship between asset classes. What does one zig when the other zags? And to the extent that you use asset classes that are not correlated or negatively correlated with each other, you can push that efficient frontier up and to the left. The other way you can really push, not really push the frontier up, in an academic sense, push beyond the efficient frontier, is by using leverage. And that's something that we believe is technically prohibited, but that is, from a academic sense, what they teach you in sort of Finance 101. If you want to go beyond this, you lever up your return is the only way to go beyond that efficient frontier. So let's get at some themes. So the Sharpe ratio is often used as a measure of risk-adjusted return. And it's a pretty fair way of doing that. But the thing is, the Sharpe ratio declines the further you move out that curve to the right. So I'll back up a bit. The curve slopes, that's why it's called a curve. So let's see, is there a pointer in here? Yeah. So the Sharpe ratio is going to be higher here because the slope of return relative to risk is much higher than it is out here. So the more risk you take on, that Sharpe ratio is by definition going to decline even if you're on the efficient frontier. That's because you're getting less marginal return for each additional bit of risk you're taking on. Looking at your particular portfolio and how fairly efficiently constructed it is now, there are a very limited number of ways for you to push that efficient frontier out. One thing we think that could be done is taking what we're going to call a barbell approach. So I'll back up again here. So by a barbell approach, we mean essentially using some asset class, more of asset classes that are down here, and more of asset classes that are up here, less of what's in the middle. Because these tend to be more negatively correlated with these. And in particular, some of those asset classes that are negatively correlated that have risk mitigating properties, and we call them risk mitigating strategies. They might include U.S. Treasuries. They might include certain types of hedge fund structures. It's something we can talk about in a future meeting. But even then, if you're going to go down that road, and this is just more of a concept than a specific recommendation at this point. Okay, if you do that, number one, it will include higher tracking error relative to your peer group. So in other words, that's a technical way of saying you're going to look more different than your peers. Number two, if you're doing more in those higher risk asset classes, those are going to tend to be things like private equity, where that's going to mean higher fees. Obviously, staff presented on ways to reduce fees than that, but still higher fees for that than, say, an index fund in public equities. 3, greater complexity to the portfolio. And 4, again, we're creating assumptions. The asset classes may not behave the way we assume they're going to behave. All right, so stepping back again, just looking at the overall simplicity theme. Also from the survey we presented in February, one of the questions was about how many asset classes do you set targets for? The vast majority were at 10 or fewer. So 2/3 roughly were setting targets for 10 or fewer asset classes. And where you were, it was only 3 of the, I believe it was 40 or so that were surveyed. And then finally wrapping up the same schematic that Jeff showed you here. Again, one way to simplify. Again, doesn't have to be the only way. So the portfolio benchmark presentation was the other one? You don't have that one? We can save that for later.
I think I told them to pull it, thinking we do it in September, but
We got hold music.
that's a new one.
Give me a minute to get it up.
Well, I can also give you the 2-minute verbal version of it.
That's fine.
Right, which I think we don't really need the slides. Historically, when you've had private market asset classes, particularly certain private market asset classes, think of something like private infrastructure, there has not been a good benchmark for it. And so public market benchmarks have been used as a proxy. You try to use something that most closely approximated. So use a public infrastructure benchmark to match up against private infrastructure. I have that one in my mind because when I was looking at, when Mr. King was going through the report earlier, I think it was for the year-to-date period, private infrastructure was down 2.6 and public infrastructure was up 16%. That is tracking error writ large. It's not to say that private infrastructure is awful and public infrastructure was great. It was just over that very short time period, there's going to be very large differences because of the different natures of those benchmarks. The good news is that it appears that some of the universe providers for private markets are now robust enough that we would consider using them. So historically, something like private equity, you might use something like a Cambridge Associates private equity universe that's comprised of all, maybe not all, but the vast majority of private equity funds out there. It is kind of a peer group of private equity funds. So not your peer group, but a peer group of private equity funds. But private equity was really the only one where that was the case. It may be core real estate, but certainly not non-core real estate. But in the last few years, a couple of the providers, in particular Cambridge Associates and Burgess, who's one of your vendors currently, have built out those universes enough that we think we're going to be comfortable recommending using those going forward. And that's what we can, I hope to come back to you at the, I believe it's September meeting, to talk in greater detail about those universes, why we may or may not be comfortable with them, what some of the caveats may be with using them going forward. So this was just sort of the preview of where we're going with that.
Thank you, Frank.
Any questions?
I have the clicker, sorry.
Now, Frank, do you agree that with the statement that I think James made, that the current portfolio is relatively efficient based on current projections?
So much so that I put it in writing.
Okay.
Yes, I do, Mr. Chairman.
Well, Frank, do you have any feeling that we should be making any changes at all?
So the changes I would have in mind, there are different things you can do. Some might be implementation type changes, which I think the CIO is already considering. And again, at a higher asset allocation level change, it is, all right, maybe you want to consider, again, more of that barbell approach, but that's a conversation I think we can have September, December. It's not a conversation that needs to be had today, nor do we have the materials to make a recommendation for you today.
Now, of course, what we have to do as commissioners then is to think about whether we're comfortable with the risk level of the current portfolio, given that it's efficient. We haven't, in my recollection, yet objected to the risk levels in any strong way. But it certainly on our minds, something that we have to think about every meeting. Okay, Jeff, does that
Yes.
conclude your portion
Yes, yes.
of the agenda?
Well, I think if I would, it seems like we've reached some consensus in regards to Affordable Alpha. And do we have, in regards to the reference portfolio, being in some consensus that is a 70-30, and that we have at least, when we think about portfolio simplification, one, that there is a desire to, which I would submit, that there hopefully is a desire to simplify the policy allocation, and is what we've seen a couple of times, a good place to either A, end up, or B, start from. Which I would submit is one or the other, I would think, hopefully.
Yeah, is there discomfort with the policy portfolio that we've been talking about? Or is the commissioners comfortable with that?
I guess.
And, this being the,
That being.
yeah, that being what we're driving towards without Affordable Alpha hedge
Yeah,
funds.
yeah.
But that doesn't have the, like, all the way back with the.
To be clear, anything that we have consensus on, the next step is we work to codify into the SIOP
Right.
for discussion. This is not, we're not talking about portfolio changes that in 2.5 weeks show up in our portfolio.
Right, yeah.
This all is, kind of feeds into how do we build those governing documents around the issues that you all have consensus on. And we create that SIOP ecosystem around these things. So we just need to kind of, if we're there, then we know what to put into draft form for that discussion. This is not.
And to begin the building, really begin building the reporting infrastructure that we'll need in order to show you the level of, a much greater level of detail and attribution. So then I think that you're, if not greater, at least a much more effective way of judging performance.
So there seems to be at least an initial consensus that Mix B without Portable Alpha is a starting point for talking about the policy mix, policy benchmark.
Okay, all right. Well, we can start working. We can do the work that's necessary in regards to that. And then I think that it seems that there's agreement in regards to the reference portfolio as well. So we can start doing the work necessary to get there. So, and kind of in the interim, if there's any directional movement that you would like that any individual commissioner would like for us to see or consider, then we can certainly look at doing that as well. So.
And before we leave that, are there further comments about that as a starting point, as a policy mix? Concerns, comments? Okay, thank you. I think
we're there.
That's a step forward in the process of allocation.
Delegated? Yes. Next item on the agenda,
Mr. Chairman, it's just the delegated investment reports.
The delegated investment report is next, and I would just remind us that both of these items have passed the board review period, so they are in effect approved by the board. So just a quick overview of what they were, and that the approval, the delegated approval took place since the last meeting.
And we'll just be mindful that lunch is here, so.
Well, why don't I just very
Everybody's
swiftly
Yeah.
go through this? Sorry. You have, well, can you just turn, this will be as brief can be. Unfortunately, our title disappeared from this. So this is the investment summary. TA is a private equity investment. It's a growth-focused manager that is one of the highest rated investments that we've been able to prosecute. The investment strategy is leveraged buyout and growth equity transactions across core sectors and geographies, businesses with high recurring revenues, high free cash flow, strong, stable businesses in need of some growth capital, looking for a competitive advantage. The portfolio construction is usually a higher number of portfolio companies, but across these core sectors shown on the bottom, and target companies that are not really small, 200 million to $1 billion check size, 75 to $400 million. They typically build platforms and do a lot of add-on acquisitions. Can you go next one? It's a new relationship for us. It increases our exposure in our private equity portfolio. We've done a lot of very large funds, looking at really big transaction. This moves us both into growth space as well as into the lower end of the middle market. TA is a very old, very experienced firm, tremendous track record. We're very fortunate to be able to make this investment. So let me move forward. If there are questions, we're happy to address them. I just don't want to dwell on this for too long. Actis is an infrastructure fund. If you could go to the next one. So new relationship for us. As you would expect, our infrastructure portfolio is still quite new. This is a firm that was spun out of CDC Group, development finance company sponsored by UK government. It's independent now, partner owned. Their investment thesis relates to building infrastructure in emerging markets. An interesting part of the strategy is that we took a lot of comfort in is they underwrite transactions, and they rely on something called MEGA insurance, which is World Bank insures developments, infrastructure developments in emerging countries, and Actis is a big user of that insurance. So it's a unique risk mitigating element to the strategy. It's a long life infrastructure fund. It's going to be roughly half Latin America, 30% Asia, some Africa, 8 to 10 investments, operationally focused firm. These are regulated or contracted businesses, mature, operational. We're not talking about development risk. And there is potential outperformance through, if they're able to grow these. So let's see here. I don't want to get into a 20-minute recap. recap. I know that you've all seen this before, so I just wanted to, let me pause, and Steve is here, if we have any detailed questions. Oh, Ashley's here, good. If we have any questions on either TA or Actis, but these are two $75 million investments that were approved. We're very, very excited about both. And this is, we think these are going to be great performers for us. So, if there are no questions, that concludes
the term limited liquidity, what does that mean in this context?
So this is a 15-year fund life, so this is not dating, this is marriage and kids and grandkids. So this is going to be in the portfolio for a good long time, but it's going to be a nice cash flowing portfolio. So I think we're going to be very pleased to hold on to something with these types of characteristics for a longer period.
So should liquidity be no?
Well, as with all private equity structured investments, we don't control that that decision. So we are in it until the manager is able to secure an exit.
With the caveat that we get secondary sale,
Yeah,
a fund investment together.
we can do that. That is not the way to get top dollar.
Yeah.
So,
The optimal means.
but that is a door that is available, but that is not the preferred exit. So we are a long-term investor, and this is a way to exploit our long-term nature of our liability base and assets in order to find an investment to improve the outcome. So I'll leave it there, went as quickly as I feel I can. So.
Ashley or Steve, do you have anything to add to that summary?
I mean, I would just, on Ashley's behalf, on the Actis side of things, this is a core investment, like in terms of the assets that we're investing in, but they happen to be in non-core geographies, so it's a way that we think we can add value, add some diversification, and also kind of take advantage of the need for infrastructure in non-developed countries or developing countries. But this is a step out for us, and we're excited about it. And Ashley's on LPAC, and we'll be able to get some good information, and stay on top of this one. And we'll be able to
I concur with that, and also note just that, it had some really interesting risk mitigations that are in place that make, kind of going out into emerging markets with core assets really, a lot less risky than might be perceived.
Yeah, thank you. Other questions on the delegated investments? Thank you.
The next item is executive session, Mr. Chairman.
We reached the point of the agenda to proceed into executive session. May I have a motion to that effect?
So moved.
And just for the record, I about said, Your Honor, sorry, that's harkening way back. The motion to proceed into executive session would be to discuss investment matters pursuant to the applicable code sections and Title IX, and to receive legal advice from legal counsel pursuant to the Freedom of Information Act. Closed meeting exemptions would be the motion. That's it, Your Honor, again, sorry.
Thank you, that's the motion, and we had a second. Any question about that, or? All in favor, say aye.
Aye. Second.
All in favor, say aye.
Aye.
The ayes have it, we're adjourned.